Okay, so we are seeing a little bit of buying as we start the Friday trading session in North America. What a busy week it has been, including some record highs, some moments of lows for the market as they assess the outlook for interest rates. And then, of course, some earnings stories continuing to drive the tape, including the mighty NVIDIA. But where does it leave us? Where do we go from here? Let's get some insight now from Kristina Hooper. She's Chief Global Market Strategist at Invesco and one of our regular guests. Kristina, it's great to have you back with us. What's been your take on what's happening in the markets right now?
John, it's great to see you. My take is that we are essentially in a period of confusion. Markets are changing their minds almost on a daily basis as to when the Fed will start cutting rates. Now, the good news is we do have more certitude around when other major central banks are going to be cutting rates. For example, the ECB looks very, very set on cutting rates at its June meeting. And so we have something of a carry trade going on where there's a focus on those areas, those currencies where we're likely to see higher for longer, like the United States. Now, having said that, I'm pretty confident that the U.S. will follow soon after other major central banks. They may not be a first mover this time. In fact, maybe the Bank of Canada will be something of a first mover this time. But I don't think it will take very long for the Fed to start cutting rates, despite some of the hawkish rhetoric we've heard, the hawkish FOMC minutes, and of course, some of the data that makes markets a little uneasy.
And how do you feel specifically about remaining invested in equities amid uncertainty on the timing around a pivot to rate cuts?
Well, I think it's all about a time horizon, but for most investors, their time horizon is long enough that they should stay invested in equities. Now, this may very well be a good opportunity to ensure adequate exposure outside the United States, ensure adequate exposure to areas that haven't necessarily performed well recently. For example, we have attractive valuations and we have a history of underperformance in areas like small caps, in some of the more cyclical names. I think that we're going to see a real broadening, a sustainable broadening of the market once we start to see central banks cutting rates. And that should be good for other areas that haven't necessarily performed as well, haven't fully participated. And valuations, as I said, are more attractive in European equities, UK equities, emerging markets equities, in the cyclicals. And so that hopefully is an area that investors start to not only look at, but start to add to exposure, especially if they're underweight there.
And do you think you'd be saying that if we weren't seeing the kind of performance we saw during earnings seasons from big companies? I think the big takeaway from earnings season that it was fairly impressive.
Yes, definitely impressive, although we can attribute a significant portion of the positive earnings results to a few companies like NVIDIA. But I think the reality is, yes, earnings season was good. And I think we have more to look forward to going forward, especially if we start to get an easing of rates. And of course, we see improvement in real wages. I think that could be a catalyst for a reacceleration in economic growth globally. So I do think that this is a good time for investors to really be assessing their portfolios, ensuring that they're well diversified.
And what goes into that diversification outside? You talked about geographies, but in terms of asset classes, how are you thinking about that right now?
So I think when I talk about diversification, I mean well diversified within equities, as well as fixed income, as well as alternatives. That can often be lost. There can just be a focus on equities, but I think there's a lot of opportunity in fixed income. Yields are in a far better place than they have been for years and years. And so there are a lot of attractive opportunities there. And of course, there's alternatives. Areas like real estate that have been beaten down. If investors have a long enough time horizon, they should be sniffing around, and I would argue adding to exposure.
All right.